You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we've got Ibstock, Royal Dutch Shell, the UK-listed banks, Barclays, NatWest, Lloyds, Standard Charter, and finally, we're going to finish with a US company, Etsy, and then there's a book review just at the end.
Should we kick off with Ibstock, John?
Yeah, we can kick off with Ibstock. So Ibstock came out with their third quarter results, and this was on a background of the company really slumping earlier this year after coronavirus and the subsequent lockdowns. Previously, back in June, they'd reported that sales were down 40% and that the housing market was not in a good state. I think brick production was down about 20%. And there was a big reduction in the demand for bricks, concrete fencing, flooring, lintels, and sleepers. What are the results like this time, Sam?
I thought they were all right given the circumstances. So for anyone who doesn't know, Ibstock is a UK brick maker. So their fortunes generally rise and fall with the construction and house building sectors, I think it's fair to say. Yeah. So when we had the lockdown in March, obviously no one was building houses, so equally no one was buying bricks. For the half-year results, they reported a 36% decline in first half revenues, falling to £131 million, and an underlying loss before tax of £11 million compared to a £42 million profit last year. The group finished the half with net debt of £103 million, which was up 66% year on year. Production stopped in late March and it didn't get underway again until May. However, by July, the clay products were back up to 80% of last year's volumes and the concrete sales were up to 85%. So just to break down the clay and the concrete divisions. So for clay products, revenue for the first half fell 43% year on year to 86.5 million. And that division reported a loss before tax of 43.4 million, which was down from a 38.4 million pound profit last year. And the concrete business saw sales fall 15% to 44.5 million, which was a 28% decline compared to the previous year. And the profits for that division fell from £6 million to a £2.6 million loss. The group has launched an extensive restructuring programme, which they're hoping will deliver £20 million of savings in 2021. However, that is costing £10 million to implement and 15% of the workforce will be affected. Mm-hmm. They reported a £14.8 million underlying free cash outflow for the first half, but they did say that the free cash flow for the second quarter of the first half was positive. And they're now expecting £16 million of additional costs due to coronavirus. So that net debt that I mentioned earlier, that's up to £103 million, that's 1.6 times the cash profits. Mm-hmm. So,
and the market cap is about 650 million or so.
657 million pounds, yes.
657 million.
It's bad, but considering that first half includes the full lockdown, it's probably expected. I think it was a well-run business going into the lockdown. The balance sheet was in, I thought, quite good shape. It's definitely not in as good shape now because of the debt. The recovery is encouraging. So they said that total group revenues in the third quarter were 88% of last year because of the recovery in volumes for house builders. And for the third quarter, they've also said that margins have improved. So they're now expecting an underlying earnings before interest, tax, depreciation and amortization of £50 million, which is compared to £122 million in the prior year. So they're expecting the profit to be about 41% of what it was last year. And they are expecting full net debt at the end of the year to be lower than the 103 million that it currently is. So it looks like they are planning to pay off some of the debt. Yeah. So I think they've been able to weather the storm. I do own this business. I think it's a very well-run business. I think it's a very attractive business to be in. And I think these results are probably not as bad as they could have been. And I think it's probably one where if they'd been in a much worse shape going into the crisis, they wouldn't be looking anywhere near as good as they are now, I don't think.
Yeah. And I mean, shares, they were sort of peaked last year after the Conservative Party won the general election, about £3.20 a share. And now we're hovering about £1.60 or thereabouts.
Yeah.
So I suppose it's reflected in the share price.
Yeah, and that £1.60 as well, the 12-month low, which was reached in March, that was only £1.31. So it is still quite close to that 12-month low. So
do you think it's more attractive than the house builders? Would you own Ibstock instead of, your Taylor Wimpey's Red Rose?
I think they're probably quite highly correlated. One thing I like about Ibstock is that this is from memory, but I think the UK brick industry, we have to import about 20% of our bricks. And bricks aren't really something that you want to be importing because they're heavy and they're cheap.
Yeah.
So really, as long as Ibstock can produce bricks, there's going to be a market for them. And we do have a supply problem in the UK. So I suppose it is a bit similar to the house builders in that respect. But I think it is a case of every brick they make, they are going to sell it, really. As to whether or not I prefer it to the house builders, I wouldn't be against having both of them. So I don't own a house builder currently, but I do own Ibstock. But I don't think I'd be against owning a house builder just because I have Ibstock. I wouldn't view it the same as having two house builders.
No, fair enough.
What do you think? Because you're the opposite. You own house builder, but you don't own Ibstock.
I don't own Ibstock, no. And Ibstock, it never really been a business that I'd looked at particularly closely, but I can see the attraction of it. And like you say, it's a well-run business, fairly small in terms of market cap, but well-run business. And it's had a history of fairly strong dividend returns. I mean, that's obviously it's been cut more recently, as with a lot of the dividends on the FTSE. But no, it would be a company I'd look at more probably, and not something I'd be opposed to owning. And I suppose at the moment it depends how you see things going forward with the house building sector, but it's attractive valuations.
I think the main issue at the minute is a second lockdown, because if we do get a full second lockdown, if the factories are closed again, then it's just going to have to take on more debt. And at the minute, I think, the debt's high compared to historic levels, but it's not concerningly high. Another lockdown, and it could be. And I think that's probably the main risk.
Yeah. So I suppose it would depend how you see things going forward, whether you take a punt on it or not.
Yeah. But based on the business as it is right now, I like it a lot. If you thought it could get back to 2019 levels, that would put it at a normalized PE ratio of just 8.8.
Yeah. And historically, what's it been hovering?
Historically, it's been at about 12. So at the minute, it's 16. It's 16.7 at the minute, but that's based on the heavily reduced earnings, they're not normal earnings.
Yeah. And I suppose if Help to Buy continuing, and there are some things you could look at more positively for Ibstock, and that we have sort of huge demand for housing in the UK and the supply is limited. So there are sort of some fundamental factors that over the long term should help the company.
It reminds me a bit of Money Supermarket that we talked about last week, where you said it's not a particularly glamorous business, but it doesn't need to be.
It doesn't need to be. And I'm actually moving address fairly soon. And what did I go? Money Supermarket on my mind. Price comparison. Yeah, not glamorous, but something that is sort of almost a necessity to you.
Yeah, I really like it. I think it's a great business.
Yeah.
The only thing I'd be watching out for is if we go into a second lockdown, what the impact on the debt's going to be, because I wouldn't want the balance sheet getting out of control. But the third quarter's it's continuing to move in the right direction. I thought it was a good quarter, and I like it.
No, and on that theme, another company that's could be hit badly, on a global scale by lockdowns around the globe is Shell. So Shell had come this week, and shares have been really, really badly hit in the last 6 to 9 months, and they're at 25-year lows, down around 60% year to date. And the company slashed the dividend back by 2/3, and that's with a history of having a solid dividend which hadn't been cut since the Second World War. So with Shell, the third quarter revenue was 44.7 billion. All of the figures we'll be talking about with Shell will be in dollars, and that was down from $89.5 billion last year. And that really reflected the lower oil and gas prices and production, weaker margin further downstream. And the profits for the third quarter were 177 million. So in comparison with the previous year, profits have been 489 million, down from 5.9 billion. So huge drop. But saying that, there was sort of positive news in that in the second quarter, the loss had been $18.4 billion. And now Shell are back into profit. So that's, somewhat reassuring, but nothing like what it had been over the past few years. And they'd increased the dividend slightly to 16 cents, but that's down from 47 cents that they had last year. So, big cut to the dividend.
Is that 47 cents last year? Is that just for this quarter last year?
Just a quarter, yeah. So
it paid quarterly, didn't it?
Yeah, paid quarterly. So if you, multiply that by 4, that was the sort of annual dividend, which I think was probably the yield back when they were paying that was perhaps in the region of sort of 6%, I think, compared with the share price back then. But they've got problems with the supply, the surge in production by Saudi, and that the breakdown between Russia and OPEC, which was earlier this year. And then that sort of coincided, it was sort of toxic, it coincided with a demand supply problem led by coronavirus. So economies grinding to a halt, and then the demand being greatly reduced. So it's sort of problems both in supply and demand with Shell. And the oil price has been, the last quarter of it, it's averaged about $43 a barrel of Brent crude. And Shell probably need it to be up in the 60s to be sort of sustainably profitable. So it's been very, very difficult for them. They have made some changes to the business. So the business slightly better shape. They've cut the dividend, and they're on track to take about $3 to $4 billion off operating costs over 12 months and reducing capital expenditure by 20%, potential for further asset sales on the cards. But no, it's oil and gas at the moment, similar picture with BG, really badly hit by coronavirus and the impact it's had on the global economy.
One thing I thought was interesting was that you said that the Shell needs $60 a barrel to be profitable long term.
Yeah.
So for most of the last 5 years, it's been below $60 a barrel. So do you think that's realistic?
It's difficult to say. At the moment, it looks a long way off getting back to those sort of levels. But these things can change. And if there was sort of any sort of game-changing vaccine that came along for coronavirus, that might impact on it. I mean, it's difficult to predict the way that the global economy would be going. I would wonder at the sort of lower energy prices, if there was sort of an improvement and growth in the global economy, whether oil and gas are still attractive in that they're much cheaper than the renewable alternatives. I wonder whether that would play into it. Yeah, rather than some of the sustainable energy that may be coming through but requires state subsidy.
My biggest concern for the industry is that I just think, even renewables aside, I still think the long-term average for the price is probably going to be downwards rather than upwards. Because I think the scenario people used to talk about where we're running out of oil, that's just not really happening now. I don't think we'll ever run out of oil. I think we're going to slowly stop using it. And I think
what do you see as the sort of the alternative to it?
Well, it's not so much the alternative. I don't know if we've necessarily hit peak oil in terms of volume, but in terms of price, I think we possibly have, because once it gets to a certain level now, you just have all the shale producers that jump back in and they just drag it down again. I don't think OPEC are able to control it in the same way anymore, are they?
I suppose it's difficult to say, but the shale producers, I'm not sure at what point they need to make profit. I mean, they've been struggling over the last couple of years with the prices being low, perhaps more so than the bigger players, the bigger oil super majors. I think it's very difficult. I think Shell, probably of the oil super majors, are not in a bad position to deal with it. They're trying to reduce debt, and they had a share buyback that they were planning. They've scrapped that. CapEx they are reducing. It's very difficult to see where it's going from here. But I think I would be optimistic in the next 5 to 10 years that the company and returning a lot of the capital to shareholders. I think they're going to be allocating another 5 billion a year to some of their more growth businesses rather than oil and gas, which are arguably in structural decline. So the sort of fuels marketed, the electricity side of the business, hydrogen and biofuels. But I appreciate that's not where their profits, really come from at the moment. But in terms of it, on a valuation basis, their sort of price to book is now 0.48, with a 10-year average being about 1.2. So they are historically cheap. Well,
I think
probably for good reason, but
I think that's for me the main thing I probably like about it, because the industry, for the long-term prospects, I don't really like them at all. It's not something I'd particularly want normally, but it's incredibly cheap.
It's incredibly cheap. It is incredibly cheap.
So it looks like the prospective dividend yield for the next 12 months is 6.6%. I don't think that's going to go up, though, is it? Because I saw that the management, when they cut the dividend, they described it as a reset. So that suggests they've got no intention to bring it back up to the previous levels. Or to me, it does.
I think the plan is to grow it again, but at a sustainable rate. And the sustainable rate, you're not going to be getting up to close to $2 a share anytime soon. So it's something where, while it's good at the current levels, and it is definitely more sustainable, because Shell was the first to cut its dividend before BP rather. And it was a case, I think, with BP, they'd be taking on debt to pay the dividend. So it was probably, they were forced to do it, but prudent decision to cut the dividend.
I saw that for Royal.Shell, the gearing actually fell compared to the last quarter. So compared to a year ago, the gearing was up to 31.4% from 27.9%, but that was a drop from 32.7% last quarter.
Yeah, so some improvement there, but I think they're focusing on getting the debt down overall is probably sensible.
I think 30% gearing, I don't think it's horrific. I think the concern is obviously if the oil price drops and it's producing at a loss. I think that's the issue of it. But providing it's making profits, I think 30% gearing, I think that's okay. Yeah, no,
I mean, I think there's an argument to be made for that, for sure.
Yeah, whereas I think if it's getting towards sort of 50, 60%, that's a lot more concerning.
Yeah. No, I would agree with you there. But I think you probably have to be quite brave at the moment to buy Shell shares, and you'd have to be prepared to really hold them for the long term.
So what's the share price actually done recently then?
So the share price, so let me have a look at that. It's at about between £8 and £9 at the moment. But in the last year, summer 2019, we were about £25 a share. And then in the last month, we've been between £8 and £9. Yeah,
I mean, I struggle to see it getting back to £25 unless the dividend goes back up, because I think that's why a lot of people bought it for the dividend, didn't they?
They did, absolutely. And the last time we sort of had a big oil price crash was sort of back in 2015. And prior to that, it had been, again, trading about £25 a share in the summer of 2014. By the summer of 2015, it had sort of been cut by, close to 40%, and it was down at about £15 a share. And then, it had quite a rise after that summer of late 2015, and rose up to, the sort of £26, £26 in 2018, 2019. And then, early 2020 was just a cliff edge.
I'm sure it won't be the lowest it's ever been, but per Google, it only goes back to 2005, and it's literally never been as low as it is now.
I think we're going back over 25 years. So it is, Sam, I think I know the answer, but is Shell a company you'd be buying at the moment?
No, but no. It's probably, I mean, it's even when the price was, it was in much better shape. It's something I wouldn't have ever really considered, just because I think it's just going to be a slowly declining industry. But I think it's probably, for me, the most tempting it's ever been.
Yeah, and I suppose do you buy into Shell and BP arguing that they're going to go into whatever the energy industry is going forward post oil and gas.
I wouldn't. If I was buying it, it would be a play on the oil price. It would be, if we get back to if we got back to that $60 a barrel where they need to be profitable, I don't see the share price staying where it is.
Yeah.
But it would be something where if the oil price returns to quite high levels, I'd probably be gone. But it's still for me, it's not. It's probably not something I want to be getting into, really.
No, and I mean, it's a reflection on the FTSE 100 because Shell and BP by market cap made up such a large portion. And I think earlier this year, before the dividends were cut, they accounted for about 15% of dividend income from the index.
What's your view on it? Do you like it?
I think it's very difficult. It's something that I'm holding, but I'd have to be very patient with. And over the next 5 to 10 years, if you come back to global growth, I think that we could see the oil price go up. And if we get rid of this glut, then the outlook may well be better. But at the moment, it's difficult to see past coronavirus and the sort of the glut that we've got at the moment. So
you won't be adding to it?
Probably not. But I guess if you were to argue it from a value point of view, it might be worth topping up on, but at the moment it's not for me.
Okay, shall we move on to the banks?
Yeah, so we've got a few banks reporting this week: Barclays, NatWest, Lloyds, Standard Chartered. A bit of a mixed bag. None of them are great, but perhaps better than what the market might have been expecting. And we saw them have small little bounces each when they released the third quarter results. So with Lloyds, the third quarter income fell by about 19% to 3.4 billion. And it's on the back of lower interest rates. Back in March, Bank of England cutting the base rate to 0.1%, so making the loans less profitable. And one of the things that was a positive for all of the banks, but particularly Lloyds, which was the biggest culprit in the PPI mis-selling, was that's now what has been wound up. So the increase in profits before tax was 50 million last year in this quarter, and this year it's up to 1 billion, excluding this effect. So the underlying profits falling by 36% to 1.2 million, but that PPI being wound up did help.
It's not bad, is it?
It's not
a 20 times increase in profits despite a 36% fall to the underlying profits.
That's right. And the operating costs as well falling. You hear in the news that closing the physical branches and move to digitalization is helping. And then again, that's despite the sort of one-off coronavirus related costs. They did have to, and this is the same with all of the banks, increase the full year provisions for bad loans, which are now expected. They're now expected to be at the lower end of previous guidance, but obviously they still are expected. There was an absence of any news on reinstating the dividend, probably politically a difficult decision to do, but overall the results were probably, like I say, probably better than a lot of people expected. And in terms of price to book, Lloyds is at about 0.41 with a 10-year average of 0.9. So it is really looking very cheap. But I guess as a bellwether of the UK economy, it depends how the direction you see that going in. And pessimistic on that, you're probably pessimistic on Lloyds. And they also, to mention with Lloyds, they do have a small but growing wealth division and insurance division, and they've recently partnered with Schroders Wealth. So that may be something that can help, even if we've got base rates at 0.1%. If that continues longer term, there's still something there that's potential area for growth. NatWest came out this week, formerly RBS, of course, 16.5% fall in third quarter revenues to 4.2 billion. Again, benefited from the non-recurrence of PPI and had a profit of 148 million. That's despite the bad loans provisions. And it was an improvement, huge improvement on this time last year, where there was a 209 million pound loss. It's got the balance sheet, you could argue, with NatWest is potentially looking a bit better, but it's probably even more politicized as a bank because the government taxpayer still owns 62% of it, and price to book it's 0.3 in comparison with a 10-year average of 0.6. So again, by historical standards, very cheap. Barclays, perhaps the more interesting of the banks. Barclays has still got an investment, or quite a large investment bank division. Third quarter, they fell 6.1% to 5.2 billion, but the offset was because the trading and investment banking divisions profit 1.1 billion before tax, compared with this time last year, which was 246 million. So that's big improvement, but there's PPI to sort of thank for that. So it's not, I don't know, if you took PPI out, it's slightly different picture, but better than probably most analysts were expecting. So Standard Chartered, they had operating income third quarter of 3.5 billion, which was down about 11%. Once you take out any sort of currency movements, quarterly profit before tax fell about 62% to 435 million. Again, they had bad loans to contend with, and they wrote down the value of the business in the UAE. And I think in early trading, after they reported, shares down about nearly 5%. So that's it for the banks. Do you have any particular banks you're interested in, Sam, from those four that have reported this week?
So I own NatWest, and I held it going into the crisis. I think it's fairly close to my cost base. I bought it a few years ago anyway, so I don't think I'm down. If I am down on it, I'm not down very much. But yeah, I held it going into the crisis. I definitely like it a lot less now than I did before the crisis. So one of the reasons I held it was I thought that it was a lot better capitalized than banks had been in 2008. It was moving, it got back to profitability. It started paying a dividend, and then coronavirus has hit. They've been forced to suspend their dividends, which is for the banks quite bad, because I think most people who had them, they had them as really, they were income plays for a lot of investors.
Yeah.
So they were forced to suspend their dividends. They were forced to write what I consider to be quite bad loans in a lot of cases. I know those are underwritten by the government, but I don't really like the intervention. I think, from a political point of view, you could argue it was possibly necessary. We won't go into that because we're not a political podcast, but from an investment perspective, I think it does make it less attractive.
Quite.
So of the four banks, if forgetting the fact that I already own NatWest, I think the worst looking ones now for me are probably NatWest and Lloyds.
You could argue that they're the best value at the moment, but to get that return, you'd really have to sit it out, and it's entirely dependent on the sort of the UK economy, and they are more Lloyds and NatWest, your high street banks. Yeah. Whereas Barclays is potentially more attractive, or could be more attractive because of that investment bank division.
Yeah, so I think it's interesting comparing the price to book as well for each of them. So Lloyds 0.4, NatWest 0.3, Barclays 0.28, and Standard Chartered 0.21. I'd probably prefer Barclays because of that investment banking division. And then Standard Chartered, I actually didn't really like it that much going into this. And I probably like it a lot more now, just because although it's listed on the FTSE, it is an Asian bank. And I think the Asian economy, my view is it's not been hit as badly as the European economies have by coronavirus. It probably looks like it's in better shape now, I think. And what I liked as well was that Standard Chartered and Barclays, they both looked like they were willing to. So for Standard Chartered, it said they would consider resuming shareholder returns at the full year results. And Barclays said they'd provide an update on the dividends at the full year results. Whereas NatWest and Lloyds didn't mention it.
No.
When you're buying the bank, I think you are primarily, it's a big factor, the dividends. So absolutely. Again, that's better for those two. So what are your views?
Those are the two, Lloyds and NatWest, Lloyds and NatWest, formerly RBS, that took the biggest handouts in the last recession. So it's politically difficult, I think, for both of them. But I mean, I think a lot of it does depend on the global economy with coronavirus, and then obviously I guess with your Lloyds and NatWest, how the UK economy recovers. So I wouldn't be bullish on any of them at the moment. Probably I'd agree with you, Barclays and Standard Chartered look the most attractive at the moment, but you could make a case for NatWest and Lloyds being very cheap, and in the long term you could get you may do very well on them investing now, but it would be, you wouldn't expect a recovery anytime soon.
No, but I do agree. I think the opportunity is there to do well with all four of them, if you do believe that we will get an eventual recovery and the banks will be fine until then. I guess they were all right, just not great results.
Not great results, no. Not as bad as they could have been, but not great results.
No, definitely not.
On the other hand, though, a company that did have very good results, Etsy.
Yes, so Etsy, for anyone who doesn't know, it's an online marketplace. I think it's possibly quite a bit bigger it's a US company, so it probably is bigger there, but it does have a UK presence. It's an online marketplace for like craft and homemade goods. So it's sort of a bit like Amazon, but for anything that's homemade. So I'm just trying to think of examples of the sorts of things you can get on there. So like art, you can get quite a bit of art on there. Any like homemade. So masks, there's a lot of homemade masks. Yeah, like a lot of homemade masks being sold on there. So my mask that I bought, it's got a Charmander on it. I didn't want like just a bog standard one, so I got that off Etsy. Our dog bed, it's like, it used to be an old whiskey barrel, and then someone's turned it into a dog bed, so that came from Etsy, and it's just stuff like that where it's very popular.
It's quite quirky,
and it's very popular for gifts as well, because it's a lot. You can get something that's a lot more personalised to your taste than maybe you could on Amazon or possibly eBay.
And you've got an army of small sellers on there.
Yes. So they have just reported their third quarter results for the 2020 year. I should start by saying that I am an Etsy shareholder.
And pleased to be one.
Extremely pleased to be one, yeah.
Okay. So what were the results like then?
Okay, so I'm just going to read some of the highlights that I've pulled out from it. But of the 138 million all-time buyers on the Etsy marketplace, about 50% of them have purchased at least once in the last year. There's 69 million active buyers in the third quarter, and the Etsy marketplace saw an influx of 14.8 million new buyers and reactivated buyers in the third quarter. Existing buyers increased their GMS, which is gross merchandise volume, by more than 50%. So that's the total amount of stuff that's sold on Etsy, increased by more than 50% in the third quarter of 2020 compared to 2019. And that's after you exclude face mask purchases. So just for a bit of background, when all the high street shops weren't able to get the masks quick enough, you had all these homemade sellers of masks popping up on Etsy, and they've sold that many masks that they're having to give results including masks and excluding masks. Because obviously,
and it probably brought quite a few new people to the platform, I'd imagine.
Yes, I think so. And I think it's interesting as well, because those, obviously in 2 or 3 years, the masks will be tiny compared to what it is now, because there's not going to be that same demand, hopefully. But what it has shown is that when the economy or something, when we have a need for something and that need is almost instantaneous, all those localized sellers on Etsy can adapt to it a lot quicker than the bigger players can. So
it's all decentralized.
Yeah. So although it won't be masks being sold in 2 or 3 years, there would be opportunities to sell other stuff that possibly people aren't thinking of right now because there's not that demand for it. And I think that means that Etsy's got the potential to be a much larger platform than if they were just selling sort of the personalized and quirky gifts that people associate them with.
Yeah. And do you think there's room for them to increase the fees that they charge their sellers?
That's a bit of a controversial one. So the sellers don't like it when they increase the fees, but so far they've been able to do it successful. I suspect that will continue because, if you are an individual seller on Etsy, you do need them a lot more than they need you.
It's a powerful platform,
Yeah, it's a bit like Netflix increasing the prices every year or so. I mean, people complain, but ultimately they have to get paying it.
Yeah, you could say with Apple and their App Store to their developers. It's sort of not dissimilar. Yeah, there is scope for that.
Yeah. So back to the report. So they said they added enhancements to their Etsy ads platform. So that means it's almost like Google in there, where you find stuff organically, but you can pay to have your stuff that you're selling listed at the top for certain stuff. So they've said they've improved the relevance of their ads and the speed of incorporating changes in a seller's budget. And these efforts have contributed to the 91.4% year-on-year growth for on-site advertising revenue. They've said their marketplace's gross merchandise volume per active buyer on a trailing 12-month basis grew 8% for the year and 4% excluding masks. So the existing customers are buying more. In the third quarter, the Etsy marketplace delivered 9.6 million new buyers and 5.2 million reactivated buyers, who are defined as buyers who didn't make a purchase in it for over a year. Habitual buyers, who are defined as buyers who have 6 or more purchase days in the trailing 12 months and they spend over $200, grew 104%. And repeat buyers, who are buyers with 2 or more purchase days in the trailing 12 months, grew 70%. Consolidated active buyers grew 55.4% year over year, and active sellers grew 42%. So the total revenue, which is just Etsy's share of what's sold rather than the gross volume, was $451.5 million for the third quarter, which was up 128.1% year over year. And if you exclude masks, it was still up 93%. Gross profit for the third quarter was $331 million, which was up 156.8% year over year. And gross margin was 73.4%, which was up from 65.2% in the third quarter of 2019. Operating income was $118 million for the quarter, which was up 730% year over year. Operating expenses were up 85% year over year, which is a lot less than the increase in operating income. And that was primarily driven by investments in marketing. Net income for the third quarter was $91.8 million, which gave diluted earnings per share of 70 cents. So not only is this an American growth company, but it actually has real earnings.
Surprising.
It is surprising. Cash equivalent, short and long-term investments were $1.6 billion. So to compare these numbers, which, by the way, I think are just staggering, to the actual size of the company, which is important, Etsy has a market cap of $15.4 billion. So that gives it a price to sales of 11.52, which I think is very reasonable for a business with a gross profit margin of 73.4%. And it gives it a price to earnings ratio of 65, which, given that the revenue is increasing 93% year over year, I think is ridiculous, to be honest.
What was the share price reaction to the news?
It was down.
It was down?
It was down. That's right. So
how much?
I think it might be down about 10% for the week.
Gosh. So the expectations must have been very high for this, higher than those numbers.
Yeah, so on the 13th of October, it hit a 52-week high of $154, and it's now at $121. And it started the week at about $139. So yeah, it's down quite a large amount. So what I find quite interesting about this business as well is, although it's up about 4x from its low in March, that low, in March, it was very low anyway. So if you look at where it had been before, I think prior to where it is now, it had been as high as $70. That was set in July 2019. That was pretty much the all-time high.
Yeah.
Now only at $121. And that's when the growth is a lot faster now than it was then. It's growing 93% year over year, excluding masks. And I think despite the 4x rise from the March low, I think it's still quite reasonably priced. Especially when you compare it to a lot of the alternatives, the alternative growth stocks in the US.
I would tend to agree with you on that. In terms of the US growth stocks, it's probably the one, if I was sort of forced to choose just a single stock, probably would be Etsy.
Yeah, I think, you can argue possibly about whether or not you think it'll be a good investment, but in terms of how, because obviously the valuation is important, but in terms of how it's performing as a business, I think it is staggering. Those are incredible numbers.
There's not a similar sort of company on the market as far as I've seen.
So Amazon did try to launch their own homemade site to compete, but that didn't work. I can't think of anything else. I suppose maybe eBay would be the closest thing, but it's not, certainly not what I use. Like, if I want something that's a bit more, if I have something very specific in mind, Etsy's where I go, because I know it'll probably be on there. But so the reason I think the share price dropped following the announcement, it was due to the guidance for the fourth quarter. So they've guided for fourth quarter gross merchandise volume of $2.7 to $3.1 billion, which would be up 65 to 85% year on year, and revenue of $459 to $513 million, which would be up 70 to 90% versus last year. They've guided for adjusted EBITDA of $117 million to $131 million, with a margin in the range of 24 to 27%. And the market didn't like that because although the growth is still going to be very impressive, 79 to 90% revenue growth, it is a deceleration. But it's just had this surge of people coming in, I think, with the lockdown. And I don't think you can't be annoyed because it's not growing 128% every single year. It's going to slow down, and it's still staggering numbers. And I just think it's very, very fairly valued, I think. A price
for what it can deliver.
Yeah, a price to earnings of 65 for a company that's growing currently 128% year on year. I mean, even if that drops to 70 to 90% year on year, within a year, that's been cut in half. And you're looking at a PE of 30. I mean, that's the same as like Hargreaves Lansdowne. It's ridiculous.
Yeah. If it meets those numbers, then
I am biased because I'm a shareholder, but I think it's a fantastic business. And despite the share price appreciation, I think it's still very reasonably valued.
Yeah, no, I would agree with you on that. But it's by conventional metrics, not the cheapest company. But if it delivers on those,
but I think conventional companies don't tend to grow at 128% year over year.
They don't. It's not the same as our Unilevers and our Reckitt's from last week.
Exactly.
I mean, we were praising Reckitt for its double-digit growth.
Exactly. This is
low double-digit growth, I'd stress as well.
I suppose this is low triple-digit growth, maybe you'd argue.
Well, disappointing for some.
Exactly. Of the companies we've talked about today, Ibstock, Royal Dutch Shell, take your pick of the banks, and Etsy.
Yeah.
If you had to buy one, forgetting which ones you may or may not already own, which one would you be buying?
Yeah. Today, I'd probably be buying Etsy.
I'd be buying Etsy. I think on most other weeks, Ibstock would probably win for me, but I think Etsy's a phenomenal business. Yeah. Which one would you buy last?
Oh, that's a difficult one. Well, in fact, it's not that difficult. I'd probably today be buying Shell last, probably.
Yeah, be last for me, but the banks would be next, I think.
Yeah, it's a toss-up, really. But the probably Shell.
What's that noise in the background?
Sorry, it's my chair creaking.
Oh, okay. Oh, you've got a wooden floor, don't you?
Yeah, I'm just,
You can't move.
Right. I can't move. Okay, so on to the book review. What have you been reading this week?
So I reread The Richest Man in Babylon. Have you ever read The Richest Man?
I haven't read it. It is a classic, though.
It's a book on wealth, but I think it's more of a self-development book than an investing book. I think it's probably bigger in self-development circles. But I reread it because I haven't read it for a number of years. I'd forgotten a lot of what was in it. And it's quite an easy book to read. I think you could probably read it in one sort of 2 or 3 hour sitting, probably.
Yeah.
So it's by George S. Clayson. It was written, I think it was about 100 years ago, actually. I think it's around 1920.
Okay.
Yeah, I think it first came out in 1926. So
pre-Wall Street crash.
Yeah, actually, yeah. So the idea is this book is set in ancient Babylon, and it just, in each chapter, it tells you a different story about people in ancient Babylon. And there's principles in these stories about building wealth. And I think the idea of the book was to show that in 1926 or whenever it was written, the same principles for building wealth that worked in ancient Babylon would still work today. And it's the principles of how you build wealth, they don't change over time, really. And I think having just reread it, I think those principles are still just as relevant today as they were even in 1926. Yeah, so it gives these principles throughout in the form of short stories, which are very, very easy to read. So I'll just pull out some of the key principles as well that I quite like. So one of the key themes in the book is that a part of all you earn should be yours to keep. And it's just that idea that if, a lot of people, they get their paycheck at the end of each month and they spend all of it. It's the way it words, it's quite clever because it's saying you're getting this money and then you're giving it to other people and you never actually keep any for yourself.
Yeah.
Which is quite an interesting way to think about it.
Yeah.
And then I also liked it had in one point, 7 cures for a lean purse.
Tell us some.
Yeah. So number 1, start thy purse to fattening. Number 2, control thy expenditure. Number 3, make thy gold multiply. Number 4, guard thy treasures from loss. Number 5, make of thy dwelling a profitable investment, which basically means own your home. Number 6, ensure a future income. And number 7, increase thy ability to earn.
Okay, so that last one and the gold points, they stand out.
Yeah.
Multiplying.
So it's talking about compound interest. And one thing it talks about throughout the book as well, which ties in well with guard thy treasures from loss, is it talks about that if you chase unrealistic levels and return, if it sounds too good to be true, it probably is. And it reinforces this principle that, if you can compound at a decent level of return for a number of years. So I think the return it quoted in the book was actually 25% every 4 years. So I don't know what they...
Over
4 years, yeah. So maybe that's 6 or 7% a year, maybe, which is definitely reasonable. Yeah, so if you do that, then that's how these ancient Babylonians were able to build up their wealth. So then there was another part, which is about a page that I'll read out, and those are the 5 laws of gold.
Okay, and what are they? What's
the 5 laws of gold. 1, gold cometh gladly, an increasing quantity, to any man who will put by not less than 1/10 of his earnings to create an estate for his future and that of his family. Number 2, gold laboureth diligently and contentedly for the wise owner who finds for it profitable employment, multiplying even as the flocks of the field. Number 3, gold clingeth to the protection of the cautious owner who invests it under the advice of men wise in its handling. Number 4, gold slippeth away from the man who invests it in business or purposes with which he is not familiar or which are not approved by those skilled in its keep. And number 5, gold flees the man who would force it to impossible earnings, or who followeth the alluring advice of tricksters and schemers, or who trusts it to his own inexperience and romantic desires in investment. And that's the 5. So overall, I thought it was a great book. I think it would be a fantastic book for a beginner or someone who's new to investing, or like just the principles of building up wealth. So as an example, if you're someone who's like interested in investing, but you struggle to save enough to actually invest regularly. But yeah, I think it's a fantastic book.
Like you say, it stresses the importance of compound interest, and also that it's not just reducing your expenditure, it's increasing your income. That's important in growing wealth, because sometimes I think a lot of consumer advice can just focus on reducing your expenditure, which you benefit to some degree, but then you're not actually increasing your wealth in the long term. You need to increase your income to do that.
Yeah, you can't compound reduction in expenditure.
You can't. Yeah, that's it. In a nutshell.
Yeah. So I think what I found surprising, because I used to be quite in self-development when I was at university, and I haven't read this book for, I don't know, 5 or 6 years maybe. And I'd completely forgotten pretty much everything that was in it, and it was interesting coming back to it and just seeing just how relevant I think it was for success in investing.
Yeah,
because it's much better known among sort of self-development circles and investing circles, I think.
Yeah, and I think it's very important to read some of these classics because they do ingrain the message in. And then when you come to sort of like we saw in March and April, there's all of that volatility going on. You've got these sort of principles that you're bound to. And I think it probably helps you be more rational in difficult situations when there is a lot of market volatility.
So I'd give it a 9 out of 10. That's my verdict.
Okay, brilliant. Well, I think that's it for this week. So thank you again for joining us, and we'll see you next time.
See you next time.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.